Hello, and in this episode of Scientific Investor Series, where we discuss various concepts around investing, we are today discussing about different styles of investing, and we want to contrast different styles of investing like growth investing, value investing, momentum investing with our scientific investing philosophy. And we'll try to highlight what are the differences and which is more robust and what are the various features that investors need to understand. So, Vikas, welcome to this webinar and podcast. Let me call it that way. So let's get into what is scientific investing, and before that, maybe what are the popular different styles of investing that people understand, and what is the one thing that one should keep in mind when it is going or chasing a particular style.
So typically, like in fundamental investing, there are various styles which have come, right?
Yeah.
And actually including technical. So in fundamental, there is growth. A lot of fund managers, a lot of active managers talk about growth. Many talk about quality.
Yeah.
Some talk about value, right? And some talk about that we focus on hidden gems, small size, unknown, lesser known companies, etc. And then there is the momentum style as well, from the technical side, right? So these are some of the popular styles with active fund managers. And also this is a challenge for investors because they don't know which style is going to perform in the next cycle, right? Yeah. And each cycle seems to have their own time. So this is what normally people do. And there is a fundamental logic to leave momentum aside to the others. But when the point which we want to make here or highlight is that actually style investing can become something which is very mechanical. Okay, and that is what you have to be careful about.
Yeah, so effectively what I've seen, or what people believe, and specifically when they're coming to investing, and if you tell me that okay, this is the style that can generate returns, then it doesn't matter to me, like whichever way I can get returns, I want to go after
True.
that. And if growth investing works, and let's say if I have seen in the past that it does, then why not try it out?
Of course. Makes sense. See, logically, you are an investor, you say, I don't care how the return is coming. I just want the returns to come. The challenge there is that what has worked for, let's say, last 3 years, 5 years, or
Right.
last 10 years also sometimes, might not work in the next 3 years, 5 years, or 10 years, right? So that is the challenge. And if you are doing more of a mechanical way of growth, which means you just, let's say, for example, take all the fast growing companies and create a portfolio, right? And then there are some favorites, etc., and you go overweight on those favorites, which is what the typical growth style investing is. Or suppose somebody is going for quality and they just assemble a lot of quality companies and create a portfolio that these are the best quality companies. Then there will be a time when it has worked, and that is when they will get noticed because it has worked in the recent past, like last 1 year, 3 years, or 5 years, and everyone will start crowding into them, right?
Okay.
And as it gets crowded, let's say it's at fair valuation earlier, it was undervalued, it became fair value, and now it's becoming overvalued, and which means it is ripe for not performing in the future. So this is the challenge with style investing. Okay.
So effectively, the biggest factor I think is the discount to intrinsic value, whichever style you are focusing on. Maybe a particular style gives you a comfort in terms of, let's say, quality, for example.
Right.
By the name itself tells me that okay, it's the higher quality company. So why not? Everyone should invest in higher quality company. Or even the growth. Just by the brand, it says that okay, it's growth, and I'm here for growing my portfolio. So why not focus on growth companies?
Absolutely.
Right? But it doesn't work because at the end of the day, it is discount to intrinsic value that
Exactly.
works out.
Absolutely.
And whenever a particular style loses that connect with the, it's not at a discount, rather it's a premium to the intrinsic value. It's bound to underperform.
Absolutely. So simple rule, right? If you buy at fair price based on, let's say, the DCF, when nobody is giving you what is that line where it is fair price, but there is a range. If you buy somewhere near the fair price, you get the market returns, which is the discount rate in the DCF. If you buy more at much higher price, you get lower than the discount rate. And if you buy at significant discount to the fair value, you will get a excess return.
Correct.
Right? So that is a given. And as we discussed that depending on the styles, if the style portfolio is available at a discount at some point, then going forward it's likely to generate a excess return above the market returns.
Okay.
But if it is at a premium, then you are looking at a negative return or a significant underperformance to the market.
Okay. And last point is on the fact that you mentioned that these can be very
Exactly.
mechanically
Yes.
implemented strategies at times.
Yes.
And is there a difference when an active fund manager is implementing it, or you use a set of rules?
Yeah, so we call this like try to differentiate between true alpha and fake alpha. And when we say fake alpha, it is not our opinion or our statement, right? This has come from the 2013 Nobel Prize winner, right? Eugene Fama, and then he works with a professor called Kenneth French and many others in the industry, in the academia, right? Who have done research on this, and they have isolated now to a 5-factor model. And the 5 factors are basically quality, value, growth, momentum, and size, right? And market. So these are the factors which drive returns, and these are called smart beta or factor investing, and this can be done mechanically. And if you are getting higher return because you have a value factor, or you are getting higher returns because you have the size factor, or because of the momentum factor or quality factor, in all those cases it's not any alpha, it is excess return, but it's because of a beta factor, right? It's a risk factor. So it's a compensation for taking that risk. Now the true alpha would be that you run this model on your strategy and it's still generating alpha beyond these factors, right?
True.
So that is something what you want to do, and we believe that the scientific investing framework allows you to do that, because it, instead of going by rules that I do this, or and in which case many times even the fund managers are not aware that what they are doing is beta,
Right.
smart beta, not alpha. I mean, they are going through the process of research and also they think they are generating alpha, but they are actually just doing beta, and they might be doing worse than the actual mechanical beta.
Correct.
Right.
True.
So, if you follow a very fundamentally oriented framework like scientific investing from first principles, which is trying to reduce the risks and trying to do a discount to intrinsic value, then you have a chance of generating true alpha. And we have done our own internal analysis on our long-term NAV, and we have seen that there is significant alpha, right? So that's there. Now, past performance doesn't mean future, so you can look at it, but this is over multiple market cycles. So I believe that it is possible. That is my point here.
True. Great. So just to summarize, style investing is at times might give you comfort in terms of those are the styles, whether it is growth or value or quality, and you might be slightly more comfortable in terms of how they have been presented, how your fund manager is using those styles, to focus on a certain set of companies. But essentially, when you just focus on style, the predictability of which style or which factor will work in the future and over multiple cycles, which is what we have seen, that anyone who is doing investing based on styles will agree to the fact that okay, this is the time horizon when a particular style will work, and this is the time horizon when it doesn't. So predictability of when to switch to which style always becomes a challenge, while scientific investing approach takes a very fundamental approach to focus on discount to intrinsic value and focus on mispricing across different types of companies, because mispricing can happen sometime in quality companies, sometime in growth companies, and sometime in different companies that you would kind of target or batch as a particular pool. And that's the strength of the scientific investing versus a specific style investing. Thank you so much for tuning in.